This week changed everything. Or maybe nothing. Let me break down exactly what happened and what it means for your money. 40 days of war. The US and Israel bombing Iran. The Strait of Hormuz, the corridor for 20% of the world's oil, effectively shut down. The biggest oil supply shock on record. And then, 2 hours before Trump's deadline to destroy Iranian infrastructure, a ceasefire. 2 weeks, brokered by Pakistan. Markets exploded. Oil crashed 16% in a single day. Stocks had their best session in a year. But here's the problem. This ceasefire is already breaking. Israel said Lebanon was never part of the deal, then launched its largest attack on Lebanon since the war began. Over 200 people killed in a single day. Iran retaliated by shutting the strait again. Over 400 tankers are still sitting idle in the Persian Gulf right now. The peace lasted less than 24 hours before the first cracks showed. Now let's talk data. This morning, the U.S. released 3 major numbers. GDP growth for Q4 came in at 0.7% annualized, an economy barely moving. Core PCE inflation, the Fed's preferred measure, sits at 3% year over year, still well above target. And personal income fell in February while spending rose. People are spending money they don't have into an economy that isn't growing, with inflation still running hot. That is a toxic combination. The FOMC minutes from March confirm it. The Fed is worried that the war could push inflation higher and force them to raise rates, not cut them. Markets are pricing in 1 cut this year, but if the ceasefire collapses and oil goes back above $100, that cut disappears, and with it, one of gold's biggest tailwinds. So here's my read on what happens next. The ceasefire holds for 2 weeks, maybe. Talks begin at Islamabad on Friday. But Israel is the wild card nobody can control. As long as Lebanon is burning, Iran has every reason to walk away from the table. And if Iran walks, the strait closes again. Oil spikes, inflation comes back, the Fed freezes, and the dollar strengthens. That scenario is actually bad for gold in the short term, which is exactly what we saw this week. Gold hit $4,850 when the ceasefire was announced, then gave back most of those gains as risk appetite returned and the dollar bounced. But here's what the smart money is watching. If these 2 weeks produce nothing, no deal, no permanent reopening of Hormuz, no real agreement, then we go back to war. And that scenario reprices everything. Oil above $110, inflation above 4%, Fed trapped, dollar eventually cracking under the weight of a prolonged conflict, and gold going back to retest the highs. The base case right now, fragile ceasefire holds just long enough for both sides to claim victory, a partial deal gets done, Hormuz reopens slowly, oil settles around $90, and the Fed gets its 1 cut in late 2026. In that scenario, gold consolidates between $4,600 and $5,000 for the next few months. The tail risk? Israel escalates Lebanon, Iran pulls out, war resumes. In that scenario, gold breaks $5,000 and doesn't look back. Either way, the structural setup hasn't changed. De-dollarization is accelerating. Central banks are still buying gold. Real yields are under pressure. The world just learned that the Strait of Hormuz can be shut down. That changes how every government in the world thinks about energy security, reserve assets, and gold. This week was a ceasefire, not a resolution. Watch Islamabad on Friday, watch Lebanon tonight, and watch what the Fed says next.